I'm Debbie LaFranchi, the founder and CEO of SDS Capital Group. I started SDS back in 2001 as an impact investment manager platform to create different types of impact funds in different geographies of the country. And for us, impact is investing to alleviate poverty. So we're investing in many of the poorest communities of our country, whether it's housing or job creation projects. And the mission was really to engage the private sector in the battle against poverty. That's really what we focus on is augmenting the capital available to fight against poverty. Yeah, it's interesting because investors have often looked at affordable housing as something that nonprofits and government focus on. It's not in the realm of institutional investing. What's been happening across our country, and certainly accelerating over the past 10 years, is that most of the housing that's being built is for families that are more than 120% of the area's median income. So, uh, middle income to luxury. That's really where the private sector and most of the institutional capital has been focused, leaving those that are 120% of the area median income all the way down to low income individuals and families. That housing is not being created at the pace it needs to be. And why it's something that institutional investors should look at is because it's becoming in such high demand and low supply that the economics, if you find the right strategy, whether it's the right fund or the right investment strategy, focusing on those real estate sponsors in the marketplace that really know how to generate a market rate of return for that type of housing, it can be a great way to diversify your housing portfolio by having affordable housing. You can get the market rates of return that you're seeking, but I think importantly, affordable housing is also more insulated from the market ups and downs of the macro economy. If you, there's high demand for affordable housing, whether the economy is doing really well and humming, and we've seen that over the past 10 years when things have been going well, there's still intense demand and a lack of supply. But more importantly, when the market has a downturn, affordable housing in many studies has shown to be a much more stable investment. And in fact, of course, demand for affordable housing goes up when the market's going down. People are losing, they're downsizing or downsizing the rent checks that they're needing to pay. So they're looking for cheaper rents that then fall in that affordable housing. Right now, this country is short over 7 million units of affordable housing. And that's across the country. The state I live in, California, is certainly one of the worst for many reasons. But even in much lower cost areas such as the South, where we do a lot of investing as well, the demand is very high and the pace of bringing new supply is very low. So it's really a great diversifier for institutional investors, and the right strategies produce the types of returns that they're looking for. Current trends in affordable housing, nothing has escaped supply chain, inflation, and interest rates. I don't care what part of the maybe data centers have. I don't know. I'm not involved in data centers, but maybe that's the one area that's been okay. But certainly multifamily, certainly affordable housing has been impacted by all three of those very intensive market trends. Right now, where we're at and what we're looking at, maybe going forward the next 18 months or so, the interest rates, inflation has obviously subsided a bit. So there's a little more certainty on cost, which in real estate is very helpful. The challenge many of us are facing is obviously interest rates are still high. Everybody's expecting them to go down. It's taken longer than we've expected. I think the trends are different depending on who you are as an investor or a fund manager or doing the development deals. There are certainly, I think most of the affordable housing is still having substantial challenges in the marketplace right now due to the interest rates. Even those developers that have a substantial amount of federal or state level subsidy, they still have commercial debt in their bucket. And when you jump up from 3% to 7% interest rates, that is going to have an impact. Uh, so I think where you're seeing positive trends in terms of the groups that are still out there closing deals and investing. And I know, for instance, we're still putting money out. We're really looking at those sponsors in the marketplace. For in our Southern Fund, for instance, it's 10 states, and we're looking for those real estate sponsors that really are able to keep their costs low. They really know their market well. They may know some of the public sector tools that can reduce risk and enhance the returns, and they can execute. And they are, despite the high interest rates, and us, despite the high interest rates, we're underwriting those projects and closing on those types of projects. But I would say that's a minority of the market. And so it is really case by case, depending on the fund strategy or the real estate developer strategy, if they're able to still put money out in what remains a high interest rate environment. Hopefully that will change soon. But right now it does take some real innovative deal makers to look at transactions. And we say no, oh my gosh, probably 3 to 4 times more now than we did before interest rates went up. So we're saying no to a lot of projects that aren't penciling. So we are having to search much, much harder, but we're finding them. And I think that's the key, is when the market changes, you have to change with it and go find those deals that do make sense. And they are out there. Well, for us, we have 2 different affordable housing type products. One is quite unique, and it's using private equity for homeless housing in California. And that fund is closed. We're not raising any more funding. And we have a homeless crisis in California, and we're financing homeless housing. Uh, Tremendous demand, 180,000 homeless people, and unfortunately, very little supply. That's why we have a crisis. So, anytime you have that mismatch of demand and supply, that's where we like to be. But I think for more the type of affordable housing in general, low income housing, so to speak, rather than housing for the unhoused. For affordable housing, the regions where we see some real opportunity is in the South. That's where we've been focusing our a lot of our funding. We financed over 5,000 units of affordable housing in the South. And what we really like there is you have proactive local and state governments, very business friendly, a lot of population growth, and with that, increased demand for low income housing, and challenges, because as population grows in communities, that bumps up the rents typically, which makes affordable housing an even higher demand because rents are going up and people are being priced out. And we see that in many statistics all over the country, the rent increases over the past 5 years in particular. But the metrics in the South tend to be, from a business perspective, from a population growth perspective, cost perspective, it's also lower cost in the South, seem to align very well. And unfortunately, there is a lot of demand for affordable housing that we're trying to fill. So that is certainly a region that we see as makes sense to focus on. Investors absolutely can find market rates of return in affordable housing. And just like there's, I guess, 31 ice creams at Baskin Robbins. And maybe there's more now. When I was a kid, it was 31. I don't know nowadays. There's different flavors, different types, and it is important. They're all not the same. Impact funds are not all the same. The types of affordable housing deals are not all the same. So investors that are seeking to look for, augmenting their portfolio and diversifying their portfolio with this niche of affordable housing really do need to understand the focus, the investment strategy of the fund manager or the sponsor they're investing with. Are they focused on market rates of return? Some are, some aren't. There are some funds that are concessionary, they're below market, and they clearly state that in their investment thesis. They're out there providing sort of subsidized capital. And then there are fund managers like us and others in the marketplace that have an investment strategy very focused on achieving the impact, but also first and foremost, making sure we're hitting that risk-adjusted market rate of return for our investors. So investors do need to sort of peel back the onion and make sure they understand the thesis of the team they're investing with, and that team understands how to source these types of deals and structure. These are often affordable housing can be more complicated. There could be other below market sources so that the tranche of fund capital does achieve that market rate of return. So they do need to do their homework but not assume that all the different affordable housing vehicles out there are the same. Each one is different with its own nuances. Our focus is affordable housing and market rate of return, and our strategy all feeds into that. And it does lead us to certain types of developers that are achieving that in the marketplace versus having a strategy that really may be using more of 100% subsidized capital model. That's not our model. Our tranche of capital is market rate. There may be other subsidies in the deal, but our tranche needs to be structured for a risk-adjusted market rate of return. For the next 12 to 18 months, the outlook on affordable housing, I believe, will be improving. I mean, for all real estate, as interest rates go down, it improves. The numbers get better. The construction loans get a little cheaper. The permanent financing gets a little cheaper. So I think assuming that the Fed does what we're hearing now in September and rates may go down, that's a positive market signal that will alleviate tens of thousands of pro formas around the country on deals. So I'm optimistic it will get better, not worse at this point. And it does seem that is sort of the consensus out there. Interest rates are the big 900-pound gorilla for everybody right now, without a doubt. Yes, this is a great question, why institutional capital is critical. As I mentioned earlier, we have a shortage of over 7 million units of affordable housing. That's families that are rent burdened. They are paying more than a third of their income to rent for their rental check each month, which reduces the amount they have for their children, for their food, and for their economic security, putting towards retirement. That is very unhealthy for this country. It's at a level that we should all be shocked and, frankly, maybe even a little ashamed about, because we are the United States, the wealthiest country on the globe, and we should be doing a better job than this. Without institutional cap, we can no longer just put affordable housing in the government and nonprofit bucket. We're not producing enough. So, and some projects absolutely need that government and the nonprofit sector for that financing. But there is a role for private sector capital where they can achieve risk-adjusted market rates of return, and they can grow this pie of affordable housing. With government and nonprofits, we can only get to here. We need the private sector to get to here. And the private sector, I do believe, is starting to realize that this is an advantageous place to be with the right strategy. That's the key, with the right strategy. And I'll just give you an example why I think this from a personal, I started SDS back in 2001. Today, we're at 1.3 billion of assets under management, all impact strategies. And we just received our very first public pension fund money after 23 years. And as everybody knows, public pension funds they are there to serve the pensioners, the public servants, so that they have a retirement. So all they can take into account is their fiduciary responsibility, not doing good, focusing on poverty and such. And we all understand that. We just received our first public pension money, 50 million from GCM Grosvenor. 5 public pension funds invested through GCM Grosvenor as one $50 million investment in our Southern strategy. And that shows that pension funds in particular and groups like Grosvenor are seeing affordable housing as an asset category that is beneficial to diversification as well as returns. Because they're not doing it because of our impact slide and the impacts. They're doing it because it makes very strong financial sense. I'm sure at a gut level, people on those teams like the fact that we're doing good things in communities, but that is not part of their investment thesis. Their investment thesis is risk-adjusted market rates of return, strong team, strong strategy, or they're not looking at it. So I do believe, based on our own anecdotal evidence here, that that for the strategies that have a focus that works for institutional investors, they are starting to pay attention that maybe this is a category of investments they should take a look at.